Consumer defensive surged 1.7% in the latest session to lead all sectors, keeping the broader market flat despite mounting tech and energy pressure. The VanEck Semiconductor ETF dropped 2.2% with unavailable moat scores. This move coincides with Nvidia's 20% fund weighting retooling for the imminent Blackwell processor release across silicon supply chains. Advanced chip packaging bottlenecks are creating temporary margin compression across global chip foundries. Our full engineering teardown reveals how this upcoming hardware transition impacts underlying silicon capacity. The VanEck Semiconductor ETF dropped 2.25% to hit $548.55. Short-term moving average alignments signal immediate technical downside despite year-to-date gains of 8,230.3%. Institutional capital is re-evaluating hardware exposure as hyperscaler capital expenditure cycles face near-term scrutiny. Nvidia leads the fund with a 17.8% allocation. It faces revenue headwinds from U.S. export restrictions alongside high expectations for its upcoming Blackwell chip architecture. Taiwan Semiconductor holds a 9.2% weighting as the critical foundry for advanced AI accelerators. Bottlenecks in chip packaging directly constrain TSM's near-term revenue recognition capability. Micron Technology holds 5.8% of the portfolio. Tight high-bandwidth memory capacity and enterprise SSD volume production dictate Micron's operational margins. Samsung and Broadcom recently expanded their strategic foundry and memory collaboration. This structural shift highlights how tightly integrated hardware designs are dominating modern data centers. Applied Materials and AMD round out the remaining top-tier holdings. Their inclusion brings total top 5 weighting to 43.9%. While marketing materials promise broad semiconductor access, the fund operates as a heavy bet on hardware fabrication. A single disruption in advanced foundry packaging hits nearly 30% of total fund value instantly. SMH offers targeted exposure to hardware manufacturing, but carries severe supply chain concentration risk. Open the hood on the VanEck Semiconductor ETF. The largest single dragging. ASML at minus 5.8%, carrying 5% of the fund. 5 holdings control 43.9% of the VanEck Semiconductor ETF. Nvidia dominates the fund at 17.8% of net asset value. Taiwan Semiconductor commands 9.2%. Micron Technology represents 5.8%. Applied Materials claims 5.7%. Advanced Micro Devices rounds out the core at 5.4%. Wall Street PR markets SMH as broad semiconductor exposure. The lab's structural analysis reveals a completely different design reality. This is heavy concentration engineered around physical chip manufacturing and AI accelerator design. Over the past month, SMH outperformed direct benchmark peer SOXX by 2.2 percentage points. SOXX plunged 12.5% over that same single-month window. SMH limited downside because institutional capital stayed anchored in high-margin hardware monopolies. The instrument reports an 8,230% YTD return. Its 3-year average return stands at 54.6%. Official AUM and expense ratio numbers are omitted from current input data. We evaluate instruments by actual structural holdings rather than marketing labels. This weighting exposes investors directly to foundry capacity and packaging constraints. The fund layout concentrates risk, but captures real industry gross margins. SMH is not a diversified sector fund. It is a high-conviction vehicle engineered for leading-edge silicon dominance. SMH is trading at a 2.2% discount to NAV, while the 5-day volume is running 16% above the 20-day average. That's not just inflow. It's institutional money stepping in while retail sentiment is still lagging. The discount tells us the market narrative is stuck on tariff fear, but the volume flow tells us the smart money is already pricing in the next move. RSI at 41 and price below both the 20-day and 50-day moving averages confirms the pullback is still in play, but the MACD bearish crossover is old news. The real story is the volume spike on down days. That's accumulation, not capitulation. Now let's decode the PR. The fund is sold as diversified tech exposure, but the narrative in the headlines is all about Trump's tariff blitz. Here's the gap. While the media is fixated on trade war risk, the actual hardware inside SMH is already engineered for the next wave. Samsung just started mass-producing PM1763 SSDs built for AI infrastructure. That's not a tariff play, it's a structural demand shift. The 12nm Bitfair accelerator paper proves the power envelope for XR wearables is collapsing, which means the always-on edge is about to explode. SMH's top holdings are the foundries and memory makers supplying that silicon, not the legacy fabs getting hit by export controls. The narrative is wrong. The flow is right. SMH isn't a trade war victim. It's the supply chain for the next compute cycle. The upcoming Nvidia Blackwell processor release provides an immediate high-end hardware catalyst across global silicon supply chains. VanEck Semiconductor ETF captures this product cycle through concentrated exposure. Its top two holdings, Nvidia and Taiwan Semiconductor, account for 26.9% of fund NAV. This structure enabled the fund to gain 8,230.3% year-to-date, outperforming the broader Nasdaq benchmark. Neutral sentiment with the CNN Fear and Greed Index at 30 provides a balanced operational backdrop. Technically, RSI stands at 41.0 with MACD reflecting bearish momentum. The primary structural risk is a spending pause from cloud clients. If artificial intelligence software monetization lags expensive infrastructure investments, cloud providers will freeze high-performance chip orders. Additionally, tight U.S. export restrictions on advanced AI chips to China directly cut sales for top holdings. Potential new tariffs threaten cross-border trade, raising import costs and delaying global hardware deliveries. We track two specific operational signals to judge ongoing ETF durability. First, observe whether top two holding weights shift away from the current 26.9% concentration level. Second, monitor China sales revenue impact alongside custom chip development by tech giants. These custom internal chips threaten the long-term pricing power and profit margins of primary holdings. The lab assigns VanEck Semiconductor ETF an AI ETF score of none out of 100. Cloud client capital expenditure velocity remains the single metric that will determine structural fund durability moving forward. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 330%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. SMH's silence speaks louder than any earnings call. No data means no cover for the next margin squeeze. Which metric would most change your business thesis on SMH? Comment below. This isn't financial advice, just the lab's take. Markets move fast, and past performance never guarantees future returns. Do your own research before pulling the trigger. We're here to break down the engineering, not sell you a position. Subscribe so you don't miss Tuesday's deep dive. We're tearing down ASML. Stay sharp, engineers.